Hi, this is Ang from Smarter MacArthur. Today we're going to be talking to Nathan Birch from Be Invested. Nathan is a property investor. He has over 180 properties in his portfolio. So let's go in and we'll talk to Nathan and get his opinion about where the property market is and how we can get started with property investing. So, yeah. Nathan, thanks a lot for this time and for talking to Smarter MacArthur.
My pleasure.
Well, first of all, Nathan, tell us a little bit about yourself and how you got started in property.
Yeah, sure. It all started back when I was 13 years old. I was looking at my older brothers. They were buying houses to live in.
Yep.
And it was a big age gap. I was a surprise package. My parents were nearly 50 when they had me. And I wanted to be like my older brothers. And I was 13 years old and I thought, how can I buy a house? And I started looking at the Homes Pictorial magazines back then. And with it, I got excited and I worked towards saving up a deposit to buy my first house at the age of 18, which I did. So that was out in Western Sydney, which is the heartland of my property journey. So, yeah.
Fantastic.
Beautiful.
So can you tell me a little bit about where your properties are at the moment, where they're located, and what's your future goals?
Yeah. From my property portfolio, it all started out in Western Sydney and the blue-collar areas of Sydney, obviously being a Sydney boy myself, growing up in the Parramatta area. I looked at what areas would have good growth ahead of them and bought within my means, not between, obviously I wanted to have nice, beautiful houses and all that sort of stuff, but I bought with what was affordable and what fit in line with my strategy. And first of all, I wanted to be able to retire from work and have an income source of $50,000 per year, which I thought was impossible to do back in the day. And with it, I wanted to have a portfolio of 10 properties by the age of 30, and I was 18 when I bought my first one.
And you officially retired at the age of
24. 24. Yeah, 24. Quit my job, and at that point I had a modest property passive cash flow coming through my property portfolio.
So what drives you, Nathan? What drives you to continue on the property journey?
With it, it's addictive. It's like a drug. I've never tried drugs out there, kids. But when you see people get an addiction, property investing is that addiction for me. And with it, for me, today, I'm still passionate about the property. I want to push myself to the next level and to the next level. And currently the portfolio ranges from properties between New South Wales and Queensland, predominantly in the Sydney Metro Basin, which is in the blue-collar suburbs of Sydney, Central Coast, Gold Coast and Brisbane. They're the heartland of where I invest. Looking at the cash flow position today, like my positive cash flow is of $500,000 per year. The portfolio would be worth over $30 million, and my loan to value ratio is 30%, under the 30% sort of level. So
that's fantastic. So tell me a little bit, what kind of criteria do you use when you look at an investment property?
For me, when I look at any properties, it must meet three criteria. The first one is that I want to make sure that I'm buying it below market value. So what I mean by that is that if you're going out there and seeing properties that are selling for 250, 300,000, I want to be picking it up with like 30, 40, 50k worth of equity in it. So I'm minimising risk from day one, and I've got upside for growth. So I'm going to manufacture some growth by buying it cheap and being able to get equity to put into the next deal. And you don't want to keep going back and trying to pull out equity from the deal because you don't want it to to be over leveraged or whatever. You just want to be able to get your capital out so you can go again and buy the next property. That'll give you leverage.
Do you spend time renovating or doing any cosmetic makeup to your properties?
Back in the early days, I used to do a lot of renovations, a lot of sweat equity because I needed to make myself, being 18 years old, I was working 2 full-time jobs. I didn't have the ability to save save lots of money to buy my next one.
Right.
So sweat equity came into the picture, and I did do a lot of renos to build sweat equity. But if I look at properties today, I don't like to even think about a renovation. I don't pick up tools to like the paintbrushes or anything like that.
So one of your criteria that you said is that the property has to be cash flow positive.
Yeah.
Do you look for other things as well, like capital growth or?
So the three keys to my property investing strategy is that it must be below market value. It needs to be neutral cash flow for the property. So whether a property is bringing in $20 per week and putting in your pocket or costing you $20 per week, it doesn't bother me.
Okay.
I don't want to be buying a property that's going to be like a negative geared property and off the plan property or whatnot that's going to be costing lots of money with tax deductions. The reason being is I want the property, if I feel financial destitute, this is how I used to think when I started building my portfolio, is that if I had to go and pour drinks at a pub or work at McDonald's, whatever, on a basic salary, I wanted to make sure that my properties were going to look after themselves in the background without factoring in any rental growth. So I want to make sure it's neutral cash flow, and I want to make sure there's upside for growth. So for me, the vision was to build 10 properties that are worth 200 grand today, buying them for 200 grand that are worth 250, seeing them go through a market cycle, which we've seen in Sydney, and it's been exponential, the growth that I've had. Like my properties that I bought for 130, 150 grand, are now worth 350, 450 grand in Western Sydney. But the thing that I didn't factor in is the fact that the rents, when they were neutral cash flow back then, are now positive cash flow by $100, $150 per week.
Yep.
I never go back to my equity, so I don't like to rape and pillage my portfolio. I like to just get the capital out and redeploy it. After 5 years, when the loans turn to principal and interest repayments, I like to watch them pay themselves down. I feel that as an investor, you go through an education stage where you work out a strategy, accumulation phase where you get the properties, and then a consolidation where you try and build a cash flow stream from that. Buying a property, I see so many people that go buy regional properties and stuff like that. If you try and catch $20 per week, $30 per week positive cash flow, I don't think that's the right strategy either. It needs to have the three criteria of having growth ahead of it by buying in the Western Sydney, Southwestern Sydney, Central Coast regions of Sydney, or buying in the Gold Coast, Brisbane sort of markets where you're going to continuously see good growth. Buying them below market value in case something turns in the market, you've got a buffer and equity built in. And having a good cash flow so you can build an income stream for the future.
Great. So most of our viewers are from Macarthur and particularly in southwest Sydney. So what's your view about southwest Sydney and just Sydney in general, the market, the current market?
Looking at, obviously being 2015, the market has grown a fair bit over the last few years. I think it's played a lot of catch up. Looking at the properties that were out there, the Sydney market has been pretty dormant since about 2005. It sort of dipped back down, had a little bit of a kickstart in the GFC where it jumped back up, but the Sydney market is catching up to where it should have been. It's been the cheap state for a while. And I believe that we've got a strong supply and demand debasement. So I feel that. So
do you think 2015 has it peaked, or has it still got a few more growth in it?
I think that the Sydney market, being in the corridors of the outer ring, being Western Sydney, Southwestern Sydney, and the likes, has still got a fair bit of growth to be had of it. And I personally think that we've got double-digit growth for 2015 and potentially in 2016 before it stabilises. The reason why I say that is you can still purchase properties in 2015 in Sydney, two-bedroom units, two-bedroom villas and whatnot, for $300,000 entry price. I don't know how much longer they'll last for. If those properties go from 300 to 350, that's already 15% growth on the property.
So with buying higher priced property, which Sydney is kind of getting towards, do you think there's going to be any mortgage stress or people perhaps not being able to pay off their loan?
I think
if interest starts to creep up.
Yeah, good question. Personally, from an interest rate side of things, I don't think interest rates are going to be heading anywhere northerly direction for quite a while now. If anything, they might come down another 0.25%.
Right.
But based on that, you will always find people that will be in mortgage stress, and in any market, whether it's a good market or a bad market.
Okay.
But personally, I don't think that properties are still affordable. People do need to make sacrifices, and I know for myself, when building my property portfolio, I made lots of sacrifices. I could have sat there and said I couldn't afford it, but I pushed myself to be able to build the portfolio.
So you told me that you worked 2 jobs just to be able to get started in your property journey.
I did whatever it takes to get there. And,
so there is a bit of sacrifice, isn't there, to get into the market?
I think today a lot of people want to have the new car on a hire purchase, and they want to get some new furniture in their new house and put that on hire purchase. And a lot of people don't want to have delayed gratification. I think it's important, especially if you want to be a property investor out there, to actually have good clarity on what you're trying to achieve, and make sure that you're working towards that, and anything that doesn't contribute to your success and the road that you're travelling, you should block out and keep going towards it. And I see lots of successful investors out there, and all it took, from a strategy, just touching back on the strategy, all it took was to purchase 10 properties that were 200,000 going back 5-10 years ago, and taking them through a market cycle like what we're seeing, we're still experiencing in this market. You can do it in 2015, is to purchase 10 properties for an average price of 200, which is $2 million. Double it to $4 million, that's $2 million, plus as long as you've got the access to the equity, plus you've also got the growth of the cash flow along the way.
So besides the Sydney market, which has experienced a phenomenal growth, is there going to be an overflow to the other states like Perth or Brisbane? Should we be looking out that way as well?
I think some states like Perth and mining field areas are on a bit of a hangover at the moment. The markets, they've been having party time. They've been going up in prices. So those areas, I believe, will keep declining or stay stagnant. There is some very good opportunities across Australia as a board, which I feel that Queensland is a corridor that will have a lot of growth, and potentially Adelaide. I feel getting a good feeling that Adelaide has got some potential ahead of it. I personally think in 2015 we'll see continued growth in Sydney. I think the regional areas of New South Wales will get a bit of a kickstart because they're showing signs of being very affordable. You can pick up in regional towns properties for like 100 grand, 150 grand still. And I believe that Queensland is probably the best valued state currently that is most undervalued to be purchasing in. So whether it be the southeast Queensland between the Tweed Coast all the way up to the Sunshine Coast is where the party will be happening.
Fantastic. Okay. So interest rates, fixed or floating interest rates. What's your preference and why? Good question. With the interest rate side of things, it just depends on what your goals are and what you're trying to achieve from your investing. If you're if you want some stability with your investing, I'd say fixing them is a good option. Personally, I don't think interest rates are going anywhere anytime soon. What you're taking a gamble against is when you fix in an interest rate is betting against a bank that has got billions of dollars worth of infrastructure and resources to be able to make a gamble against a bank that you're going to outsmart the bank to get a cheaper interest rate. A lot of people get caught in the fact that it's good stability and good time to be able to fix interest rates, but I've been seeing that for the last 5 years, and people fixing interest rates not being able to get the cheaper interest rate that we're seeing now. There's many pros and cons to that. We could go on about it all day. The one thing that I would say out there to viewers today is to be very careful of fixing your interest rates, because it actually locks you into the bank. And if you want to be able to refinance your property or pull out some equity and you can't, go to that bank to get the equity, you have to take it to another bank, there are actually break costs that are fixed at the back end of it, which I've experienced this firsthand, and I've seen lots of other people do that. But personally, I leave all my rates on variable, and I don't go shopping for rates. Actually, I look at which bank's going to be able to support me and support my goals. So a lot of people are too focused on how can I save a couple of
like a 0.05% interest rate, when I look at it and think, okay, if I'm paying an extra 0.25% interest rate and being able to service better at a certain bank, or the bank's, being able to support my goals, because every bank's got different lending criteria based on what the property is that you're buying and the attributes that it brings. So, for example, you might be able to buy a commercial property with 60% for someone, and going to another lender, you might be able to get 75% lend on it.
So do you factor in, if you're buying a property and you're looking ahead, 1 year, 3 years, 5 years from now, do you factor in a certain increase in interest rates? Do you take that into account?
Good question. I do take it into account when purchasing a property, but also take into account that there are many variables. 2 years, 3 years, and 5 years is a long time. If your cash flow is something you want to be protective of, fixing can be sort of a rate to get it cheaper in the current market. But what you've also got to remember and be mindful of is that as interest rates could potentially go up, they could potentially come down, as well as the fact that rents could go up as well. And there's many variables, so it is something that I'm always mindful of, the cash flow and potential hikes. There's no given sort of formula as to what I would factor in, because interest rates could be set to spike up or they could be set to drop. Personally, I like to keep an eye on the actual whole market as far as interest rates, and I follow the RBA's decisions and the same formulas that they use to make their decisions on interest rates increasing or falling for my own portfolio. So I use that same data that they use to predict what's going to happen in the future.
Fantastic. Well, Nathan,
and it's looking good, guys. It's interest rates are going to stay stable.
That's great. First-time investors, if they were to ask you, what do I need to do to get started in property investing, what would you say to them?
For property investors starting out, the first thing I'd be saying is make sure before you do anything, guys, is to make sure that you've got a clear and defined plan on what you're trying to achieve. Without having a plan, you don't know where to go and where to shoot for. So what I mean by that is that if your vision is to create a $50,000 passive income per year, it could be $500,000 passive income, but I think 50 grand or 100 grand is a good starting point. Make sure that each property that you're buying is going to get you closer to that, because I see so many people that go out and buy properties willy-nilly because they think it's good for them to get themselves into the property market. But if they had a plan where they know exactly what they need to achieve, then they can take the steps required to get there. So from that perspective, having clear and defined goals is number one. Getting yourself educated. There's lots of free resources out there, obviously, such as this video, and there's lots of stuff on the internet, being forums and YouTube and all that sort of stuff to get information from. Make sure that you don't get caught up in any of those shambles sort of scammer sort of companies that are trying to sell you properties and whatnot. And make sure that you understand exactly what you're getting yourself into. Because a lot of people go, okay, I've bought this property and the salesperson's told me to buy it, it's going to be good, and they don't understand it. So numbers don't lie. If you can understand how the numbers would stack up and help you grow your portfolio and get into a better financial position, take steps to do that. The last and final one is to make sure that you take action. The most wealthiest place in the world is a cemetery. People that didn't achieve and do what they wanted to do in life. And I see so many people get caught up in analysis paralysis of wanting to do something but not taking action.
So just to summarise, you had a goal of buying a $200,000 property, and it was to accumulate about 10 property. And where did you where did you go to get the confidence in order to jump into the market back then?
Trial and error. Okay. It's underneath the gel in my hair today, guys. There's a lot of grey hairs, and it's something that it's a lot of forecasting and analysing data and research. Countless years that have been spent in the research that I've put into building the portfolio, and unfortunately at the time I didn't have any sort of mentors or anything like that. I just went out and had a goal, had a vision, took a crack at it and made it happen. And
obviously you learnt from your mistakes, because this is how you evolved.
Fortunate enough, there's never been any sort of costly mistakes. There's opportunity costs that I've lost along the way, which would be the most costly ones that I'd say. And opportunity costs come in from the fact that I shoulda, coulda, woulda, and the most the worst deals that I've done are the ones that I didn't actually pull the trigger on, make happen.
Right.
I'm fortunate enough to be able to say today, with 180 odd properties, that I've never lost any money myself. And those that I've helped out have always made a profit from the properties that they've invested in as well. So.
Fantastic. Well, Nathan Birch, thank you for your time, and,
That's right.
and thanks for sharing that with our audience from Smarter Macarthur. We've just spoken to Nathan Birch from B Invest. If you want to find out more about what B Invest does, and if Nathan can help you in any way, you can go to Be Invested. That's edinvested.com.au. Nathan, thanks again for your time.
Awesome. Thanks for having us. Cheers.